On this week's Money Minutes with Seb, we're going to unpack something that came out of the Bank of Canada last month, and if you haven't heard about it yet, it's worth your attention. At the very end of May, the Bank of Canada released their 2026 Financial Stability Report. Now, I know that sounds like something only economists read over breakfast, but stick with me, because what's in this report directly affects Canadian homeowners, investors, and anyone with a mortgage coming up for renewal. If you're not planning on watching this entire video, here's the short version. The bank is saying things have held together better than expected, but there are some serious risks on the horizon that every Canadian with a mortgage, investments, or both should know about. If you are sticking around, let's break it down in plain language. Risk number 1, AI stock concentration. This may be something that might surprise you. A significant chunk of global stock market gains right now are concentrated in a very small number of technology companies, specifically companies tied to artificial intelligence. We're talking about a handful of stocks driving the bulk of index returns. Now, the Canadian market isn't as AI heavy as the S&P 500, but here's the thing. If you hold global index funds inside your RRSP or your TFSA, you almost certainly have exposure to these companies. They're hard to avoid when you're invested in broad markets. The Bank of Canada's concern is straightforward. If something rattles those AI stocks, a bad earnings season, a regulatory crackdown, a shift in investor sentiment, the fallout doesn't stay contained. It spreads. And when gains are this concentrated, so is the risk. This isn't a prediction that AI stocks are about to collapse, but it is a reminder that diversification isn't just a buzzword. It's protection. If your portfolio is leaning heavily into one sector or a handful of names, that's worth revisiting. Risk number 2, hedge funds and bond markets. Bear with me on this one. It's a bit technical, but I'll make it make sense. Hedge funds have been making very specific bets in government bond markets, a strategy called basis trading. And the Bank of Canada is flagging that if those hedge funds suddenly pull back, it could make those bond markets less liquid, less efficient. Why does that matter to you personally? Because government bond markets are the foundation that lenders use to price mortgages. When those markets get choppy, it can affect borrowing costs in ways that are difficult to predict and not always in your favor. Again, not a guarantee of anything, but a risk worth understanding. Drop a comment below. I want to know, are you worried about any of these risks personally? Your mortgage, your investments? Let me know. And speaking of mortgages, let's talk about the part of this report that hits closest to home for most Canadians. The mortgage renewal picture. Now here's where it gets most relevant to everyday Canadians. The Bank of Canada acknowledges that mortgage renewal stress has eased somewhat. Borrowers have managed higher rates better than many economists expected, and that's genuinely good news. But here's what I want you to hear clearly. A large number of Canadians are still renewing mortgages this year and into next year, moving from rates they locked in at 1.5%, 2%, even 2.5% into today's rate environment. Even with the cuts we've seen, that adjustment is real, and it's landing on real families right now. As a mortgage professional, here's what I tell any client facing renewal. Don't wait until the last minute. Understand your options before you're up against the clock. A licensed mortgage broker can shop multiple lenders on your behalf and help you find the best structure for your situation. Whether that's a shorter term while rates continue to adjust, or locking in something that gives you certainty and peace of mind. Informed decisions will always beat reactive ones. Here's the good news. The Bank of Canada is also very clear that Canada's major banks are in solid shape. Capital reserves are healthy. The banks have been stress tested against some serious scenarios. Falling home prices, rising unemployment, mortgage delinquencies at multi-decade highs, and the system is built to absorb it. This is not 2008. Canada's banking guardrails are real. The takeaway here is this. The Bank of Canada doesn't put out these warnings without reason. When they say we see vulnerabilities, the smart move isn't to panic, it's to prepare. Diversify your investments. Know your mortgage renewal timeline. And if you have questions, work with professionals who understand the Canadian market and your specific situation. That's what they're there for. Knowing the risks and your options keeps you in the driver's seat. More prepared, more confident, and better positioned to make smart decisions no matter what the market throws at us. If you've made it this far, Hit that subscribe button and the notification bell so you don't miss a new Money Minutes when it drops. And if this one was useful, share it with someone who could use a heads up right now. That was your Money Minutes with Seb. Catch you next time.